Hey everyone, welcome back to Wealth Finance 61. Let's get into it.
Most people believe the stock market is a giant casino controlled by insiders in dark suits. They imagine flashing screens, secret algorithms, and fortunes made in seconds. But what if the market isn't a machine built to confuse you at all? What if it's simply a system of ownership that has been misunderstood for generations? To understand how it actually works, we have to rewind centuries. In the 1600s, global trade was dangerous, expensive, and uncertain. Ships would sail for years, and sometimes never return. Investors needed a way to spread risk without losing everything. That solution appeared in the Dutch Republic with the Dutch East India Company. For the first time, ordinary citizens could buy small pieces of a massive trading venture. If one ship sank, investors did not lose it all. Risk was divided, and ownership became tradable. This innovation created something revolutionary. Ownership could now change hands without the company shutting down. A marketplace formed where people bought and sold these pieces. The stock market was born from necessity, not speculation. The idea crossed the Atlantic and found a home in America. In 1792, traders signed the Bretton Woods Agreement in New York. That agreement eventually became the New York Stock Exchange. It formalized how ownership of companies would be exchanged. At its core, a company is simply a collection of assets and ideas. Factories, trucks, and inventory sit alongside patents and brand reputation. Take Apple as a modern example. Its physical products matter, but its brand loyalty drives enormous value. When you buy a stock, you are buying a fraction of that basket. You are not lending money like a bank would. You are becoming a partial owner of the enterprise. Ownership means sharing both risk and reward. This is where confusion often begins. Many people mix up stocks and bonds as if they are the same. A bond is a loan with a fixed promise attached. Stock is a claim on whatever remains after debts are paid. Cause and effect govern this hierarchy without exception. If a company collapses, bondholders are paid first. Stockholders receive only what is left over. That leftover can be massive or it can be zero. Over time, markets expanded beyond a handful of traders. Railroads, steel companies, and oil giants raised capital from the public. Ownership fueled industrial growth across the United States. The market became a bridge between savings and expansion. But growth created excess, and excess created bubbles. In the 1920s, speculation outran economic reality. Investors borrowed heavily to buy stocks at rising prices. When confidence cracked, the crash of 1929 followed. The Great Depression exposed the breaking point. Panic selling drove prices into the ground. Banks failed, unemployment surged, and trust evaporated. The market reflected fear as quickly as it had reflected optimism. Regulators responded with reforms and oversight. Disclosure rules forced companies to reveal real financial data. Institutions were built to reduce manipulation and insider abuse. The goal was stability without destroying capital formation. Yet cycles never disappeared, they only evolved. The dot-com bubble inflated on internet dreams. The housing crisis spread through leveraged financial products. Each era believed it had engineered away risk. The pattern repeats because human emotion repeats. Stock prices move on, supply and demand. Demand rises when people expect profits to grow. Supply overwhelms when fear replaces optimism. Today, trading happens in milliseconds through digital platforms. Apps have replaced crowded floors and shouting traders. Ownership transfers with a swipe instead of a handshake. Technology accelerated access but did not remove risk. Investors earn returns in two primary ways. Prices may rise as companies expand and generate profits. Some firms distribute earnings as dividends. Others reinvest everything for future growth. Consider the S&P 500 as a broad reflection of this system. It tracks hundreds of America's largest companies. Over long periods, it has historically trended upward. Short-term swings often hide long-term momentum. Failed fixes often come from misunderstanding the objective. People try to time the market or chase quick gains. Statistics show most participants struggle to outperform consistently. Discipline usually beats prediction. The first takeaway is that stocks represent ownership, not gambling. The second is that risk and reward are permanently connected. The third is that diversification reduces long-term damage. Ignore these lessons, and history tends to repeat harshly. The warning is simple, but uncomfortable. Markets amplify human behavior more than pure logic. Fear and greed can dominate for long periods. Anticipation without understanding invites costly mistakes. The stock market is not a mysterious casino. It is a mechanism for distributing ownership and risk. Those who respect its structure often benefit over time, while those who misunderstand it often pay for the lesson.
Alright, that's wrap for today. Thanks for watching Wealth Finance 61.